Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice. Nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello, everyone, and welcome to the Retiring Real Estate Investor Podcast. I'm your host, Brandon Bruckman. I'm honored to be joined by Stuart Heath today. Stuart, how are you?
I'm doing great, Brandon. Thank you for having me. It's my honor to be here with you.
Oh, that's awesome. So a little bit on Stuart, and I'll give him the floor to introduce himself. But Stuart's the CEO of Harvard Grace Capital. That's an extension of Harvard Grace Corp. Been a real estate investor for over 20 years, focusing on commercial. That includes retail, storage, and then gymnastics facilities. I definitely am going to ask questions about that. And I would assume multifamily too. Do you want to introduce yourself a little bit further for the audience? Let them know who you are and how you kind of got here.
Sure. As you said, I'm a CPA. I got here because I actually saw a lot of my clients building wealth, and I say it's not a get rich quick scheme. Real estate can be a get rich slow scheme. And so I saw them building wealth over 10 to 15 years by doing all kinds of things in real estate. And just quickly, I sort of grew up, if you would, in the late 80s, early 90s. I'd been out of college 1 year when they passed the 1986 Tax Reform Act, and which devastated a whole sector of real estate because of the retroactive tax changes. And banks went through a period of time where they wouldn't lend on real estate, which is just kind of brilliant. And so I came in out of my infancy of a business person thinking, oh, real estate's bad. Mm-hmm. And so when I left a big accounting firm and started my own, I ended up picking up a lot of real estate entrepreneurs as accounting clients, and then I just started watching them, and just like one day in about 2000, like, I think I should try this. It's and it's the kind of asset that almost everyone can try. So anyway, that's how I got here, and I started out with one duplex, and then at one point had 200 personal residential units that we owned. Most of those were duplexes. It's still a unit's a unit, and I don't really like residential, and so then I've migrated into commercial. So,
a lot of different ways to go.
Yes.
Then we maybe start on. It's very interesting. I think that many of our listeners maybe don't remember, or some maybe weren't alive in 1986. Like walk folks through, like, I'm trying to imagine a period of time in which banks won't lend on real estate. Like, how did the savvy real estate investors sort of survive and thrive during those periods? Do you have to, were you intimately understanding some of their situations? Like, what did folks do?
Well, thing about real estate, in my opinion, there's always somebody who will lend. And there is no better collateral than real estate. So a lot of the big banks that had been in real estate, back then we're talking about Bank of America, Sovereign's Cap, Sovereign Bank. Of course, most of them merged together by now. But the big name banks They had backed away. But the commercial banks are always there. I mean, the community banks are always there. Back then, this is before the S&L crisis. You could actually argue that the 1986 Tax Act created the S&L crisis because, and they were the primary go-to lender of most smaller real estate deals anyway. And what the act did was, by taking away tax treatment, they actually devalued the properties. Um, Probably should have been done anyway, because a lot of those were not smart economic deals. But the laws at the time were offering 4-to-1 tax write-offs. You put in $50,000 and hey, you get to deduct $200K. Whether you had any at-risk basis of that or not, doesn't make any economic sense. And a lot of those deals didn't make economic sense. So you take that away, the values of the properties fall. Therefore, the collateral is no longer supporting the loan, i.e., the banks fail. They have bad loans, and the S&Ls cratered, and basically did away with an entire type of financial institution.
It's phenomenal to watch when we talk to our clients going through, let's say, periods of stress. Like, the overarching theme that keeps popping out to us, and curious if you would agree, is if we have the leverage down, modest and reasonable leverage, and people are still paying rent, be it a business or individuals, we're doing okay. We can kind of navigate and survive. I'm hearing the same thing here. This is a repeating theme. Regardless of the stress that we face, it seems to be the same playbook that folks sort of need to follow. Would you kind of agree?
Totally. I call that cash flow is king. If your tenants are paying, all avenues for survival are available. Do you want to borrow and build an addition right now? Maybe not right now, but I think lower rates are coming. I never did think they were coming this year. I think they might come sometime the second half of next year. But they're coming, and if you're surviving now, if you're doing okay at 8.5%, you're going to do great at 6.5%. So cash flow cures all sins, I like to say.
I like that. You mentioned some of the residential. You owned a lot of residential, and now you don't. What inspired that transition, and why don't you like residential?
Well, I'll say this. I like residential from afar.
I like living in my house. Like, that's cool.
Yeah, I manage everything that we do. When we bring an asset to market, we also do the property management as well as the asset management, and therefore we invest in a fairly tight geographic area. And so that just comes from, I guess, being a control freak. When I first started doing this, I tried to do it passively myself, and I determined that, well, I can manage the property or I can manage the manager, and so I've always just opted to cut out the middleman. I would say that I had one of my first big mistakes is I was in the wrong type of residential. I'd gone the blue collar route, which I thought would be safe because those people would always have jobs and stuff like that. And we went through a time where they did not. You're also dealing with a relatively unstable economic culture there, and it just wasn't good. It was far too active, and in my way of thinking, people are not rational when it comes to their homes. And I'm a CPA. I'm used to dealing with business people. Therefore, the commercial world just works better for who I like to deal with. So, but residential and multifamily is the foundation of all real estate. It's really the foundation of the economy. In my opinion, I just don't like to manage it.
Amen. As someone who doesn't manage properties myself currently, I would sort of agree. So then talk about that transition. So then how did you make that transition then from residential to commercial? Did you sell all the residential? Was that in one fell swoop that you sort of did that?
Now, over time, I had to survive the 2009 crisis, and frankly, gave some of them back to the bank. Others we sold at an appropriate time, and then I was out of real estate holding for several years, but got back into it in 2017. And that time, I decided to, all right, I'm going to do commercial. And what I had done before, I'd done with all my own money, and sort of refinance this property to go have a down payment on that one, did what they call the equity ladder thing. And this time I wanted to I wanted to build it properly. I wanted to we started syndicating deals, which we also invest in. We build in reserves, and so each property sort of stands on its own. And I just wanted to, what I call building it right, this go around. And it's hard to syndicate a single family home. We started going out and doing deals from 3 to 15 million. So that's still kind of the area that we invest in.
Gotcha. And then, so what property types are most of interest now? And then you mentioned in a little bit of the show notes, office buildings. So I don't know if this is the right time to talk about it, but
Sure.
I definitely want to talk about it.
Yeah. An office was the first building that we ever took down as Harvard Grace Capital. Mm-hmm. And I had actually managed it. I'm a CPA, and I still have some CFO clients, and I had actually managed this building for them for several years. And I've been telling them for years they need to sell it. And so when they decided to sell it, I said, okay, I'll buy it. So, it was very amicable, and I wasn't trying to hoodoo them on the price or anything, but still, it was 2021, and we're doing an office deal. This is post-pandemic, and if you remember, office had been declared dead. Some people still think it's dead, and like I said, I'd managed this property. It was full before the pandemic. It was full throughout the pandemic. It was full at the time we bought it. It's full now. And here's my shtick on offices. The financial media loves to oversimplify and overgeneralize. You say office market. Well, there's about 6 subcategories of office. Mm-hmm. So it can't all be dead. And it's not all dead. And if I look at all the subcategories, there's only one, in my opinion, that's really struggling and in jeopardy, and that's Class A office space, or usually found in a central business district somewhere, maybe in a suburb type business center. But it's the Class A stuff, with the marble floors and the royal bathrooms and all that kind of stuff, that where the tenants typically don't see their tenants. They're just places where their employees used to go to and don't want to go to anymore. Mm-hmm. The one we bought first was what I call suburban office. Some people call that service retail. And every single one of our tenants in that building, they meet their customers there. They're all consumer facing. They're mortgage companies, they're insurance brokers, they're dentists, and stuff like that. And they haven't gone anywhere. And some of those are legally required to have office space. Mm-hmm. You can't be a mortgage broker and work out of your house. You might work out of your house, but you also have to have an office. Mm-hmm. So, and so forth and so on. So to me, it all really comes down to the tenant mix. Because even in the residential world, you're in the business that your tenants are in, mm-hmm. Whether it's commercial or residential. Another class is medical office. Love medical office. Medical office, I don't know that has ever had a recession. There might have been some local problems somewhere, sometime, where they overbuilt for a time. Mm-hmm. But your doctor's not going remote. So medical office, which is still office, not going to have a problem. So I love office.
Interesting. Where does that, and it's fascinating too, as you can see the folks that are watching the picture behind me is Milwaukee, Wisconsin, where I'm located out of. And it's been a fascinating, I'd be curious about your thoughts here. I don't know if you've looked at our market, but what's happened over here the last 20 years is fascinating. Traffic used to flow to the city, it now flows to the suburbs. So people live here, they work out there, right? And that's exactly what you're talking about. The suburban office is very much alive. And I fall into the category of someone like that. I'm talking to you from my home right now. Do I see my clients in my home? Absolutely not. Will my clients find that weird? Yes. My family find that weird? Very much yes. Right. So I need an office space too for folks to meet. So it's a very interesting distinction for folks. Is you're right. I think when we think about office, we think about going to work, but no, you're talking about folks that need to meet clients in this space. That's not going anywhere. And it's also fascinating in our market. We could use Class A for the people who actually do want to go there and do want to be in the office. We got Class B for days. It's 1970s, 1980s build Class B. We got that all day long. We don't have any new stuff at all. And folks are looking for it. So it's much more dynamic.
That is very interesting.
Yeah, it's much more dynamic than folks give it credit for.
And I think you want to boil down to it, the office problem, the office debt wall problem in all this is actually going to end up being highly regionalized and not to go political, but in a lot of blue cities, frankly, not every one of them, but a lot of cities where people are still fighting going back to work. I'm in the South, where we kind of pretended there was no pandemic from about June 2020 forward. No, hardly anybody ever really stopped going to work here. Although the hybrid work model is alive and well here in the South, and I think that's here to stay. So some companies are reducing office space, but they're not getting rid of their office space.
Yeah. No, it's very interesting. What markets, then you mentioned very tight markets as sort of focused on. Can you kind of talk us through those?
Yeah. So I am located, at the moment, in a little town called Fayetteville, Tennessee, which is southern Middle Tennessee. I'm about 10 minutes from the Alabama border, which puts me, 20 minutes from Huntsville, Alabama. So I call our market the 840-565 corridor. So that's two interstates. One of them's going through the top of southern Middle Tennessee, and 565 goes through northern Alabama, and I like everything in between. We'll cross over that a little bit. I love Nashville, although there's a lot of competition up there. So I like these smaller markets where you can get great economics, but you don't have all the big institutional players coming in there trying to eat your lunch. So south of Nashville, down through Middle Tennessee and Huntsville, now the largest city in Alabama. It's booming. A lot of government and industry investment there. Been growing for the last 10 years, and has doesn't show any signs of stopping. So we've done a lot of investing in that market as well. So anything that we can get to within an hour from where we are, so that's kind of our market.
Gotcha. Great area. Talk about, we maybe skipped over Harvard Grace Capital and Harvard Grace Corporation. Can you talk us through like maybe how the organization is structured?
Sure.
Give us some more insight into that.
Yeah, Harvard Grace Corporation I formed in 2010, and I just really formed that to run a consulting business out of, and I did a lot of fractional CFO work, and about as soon as I formed it in 2010, I took a full-time job. So it stayed dormant for a few years. Brought that back up in 2017 when I laid myself off from my last job. I structured a reduction in force plan, and I was in round one, and immediately that employer became my first client. So you know how that goes. And so I've just used it to do fractional CFO work. and sometimes some other one-off consulting gigs. When I really wanted to get back into real estate, I formed Harvard Grace Capital Corporation, which is a subsidiary of Harvard Grace Corp, and really that's our main focus. I do still have clients. I'm not actively seeking to grow the CFO practice, although that does seem to come, the opportunities still seem to come that way, because success breeds success. I mean, that has always been the case, especially in professional services, and we're very blessed in that we can be very choosy as to which of those engagements we are willing to take on, because becoming somebody's CFO, fractional or otherwise, is kind of like, dating and getting married. You're going on the inside. It's not just, I'm gonna run this consulting gig and here's my report and leave. So yeah, you gotta like the people you're dealing with. So that's how we're organized.
Yeah, it's somewhat similar to our business. It's deeper. You're going deeper than we are, which is very interesting sort of business too. All right, gymnastics facilities. I can't hold back anymore. I gotta know. Like, talk to me about. I remember. So here's context too, right? We have 2 older daughters and a son. All of them at one point or another have participated in gymnastics in these buildings, and I've always been sort of curious, like, how does this business function? Are they making money? Who owns the building? Do they own the building? Right. So talk us through like some of the ways you think about the gymnastics facilities.
This is this is nothing more than, this is the building I never wanted. But right next to it was was our flagship storage property that we bought in December of 22, and the guy that owned it had built this gymnastic facility, and here we're doing this contract, and I want that. He says, well, do you want that? I said, no. Lo and behold, we do the contract, get in due diligence. It's on the same parcel, legal parcel.
Oh,
I said, well, can you subdivide it? And down in Huntsville, Davidson County, I mean, they're going to go back and forth and point at each other, and it would have taken 9 months to get and it in fact did. And so, the operator who was there had been there since 2007. Impressive lady, really good business head. Yes, she makes money, and she is regionally known, and they have regional competitions there. So I met her and just said, screw it, I'll buy that too. It was a pretty decent lease. Had 10 years to run on it.
No,
it was triple net. Wasn't going to really cause me any trouble, but we did go through the process of subdividing it, and we actually just sold it last month. For a 16% gain, which we're pretty proud of, because we financed it when we bought it at 5.4%. Yeah, and we all know what's happened to interest rates since then, and that has a compounding effect on triple nets, which usually have stable lease rates. Anyway, we got a good price from a 1031 buyer. I love those guys, because especially, the closer they get to their deadline, the price goes up. So, so anyway, so that's the story of that. It was the property that I had to buy, but we did okay with it, and so that's.
So now you got.
We're not going to start a gymnastics facility fund or anything like that.
But now right? So if it pops up on the radar again, you're like, oh, I know how to do that.
Or, exactly. Exactly. Yeah.
I can tell you they're making enough money in there to cover rent. That I can confirm for you.
Oh, far more than that. She's actually opening up 2 more facilities.
Oh, wow.
And while I consulted with her a little bit on that, I was glad I wasn't her landlord in case something went wrong.
For sure. How many deals do you guys look to do on maybe a per year basis, and then maybe walk through sort of the capital structure and how you sort of think about that?
Yeah. Ideally, we are we're organized so that we never have to do a deal. Okay, so I think that's important, and I think our investors like this. We're not doing deals to drive fee income for Harvard Grace Capital. Obviously, the fee income is nice, but we're also investors in these deals. So I would think at most we're going to do 4 deals in any year,
Mm.
and unless and until we build up a little bit more staff and we can process more than that.
Mhm.
But when we're doing a deal, it's kind of all hands on deck kind of thing. So 1 a quarter, although it looks like we might do 2 this quarter, but we didn't do 1 in Q1. That's just how it falls. Each deal we do is a single asset entity, special purpose vehicle, some people call it. And so the equity is syndicated separately for each deal. Right now we've got 20 million under management, and my thoughts right now strategically is when we get over 50 million under management, we will start looking into doing a fund.
Mm.
Yeah, I've never liked the pressure of a fund that got this money, I better go invest it.
Yeah.
I don't like that psychology.
Mm.
Although, I've probably lost some investment in the last 12 months because people had some money and I didn't have a place for them to put it.
Mm.
And so it is it's a rock and a hard place kind of thing. There's advantages to both sides.
Mhm.
So, generally, we structure a deal pretty simple. The Class A investors, which is people putting up the cash, they'll get an 8% return, and after they get all their money back and that 8% return, then Harvard Grace Capital gets kicked in for 40% of the deal after that. We like to run a deal and refinance it and do the refinance and hold. We're not seeking deal fees. We do have deal fees, but our MO is we want to really hold these assets for a really long time.
Mhm.
There's a certain amount of management efficiency that comes along with that, get to really knowing your tenants and your property.
Mhm.
So we like that, and then you can just every 3 years, if the market's right, should be able to refinance your property if your leases are structured properly, and
Mhm.
pull out tax-free money, and away we go. So usually it's 8% preferred return and a 60-40 split after that.
Gotcha. Yeah, it's the first part of what you said there is so tremendously important of I don't have to do a deal. And those are the kind of things that we want you to be in that position. And I'm curious about how you think about sort of scaling into this concept of syndication versus fund, or we watch some people do both, depending on the construct of whatever deal they're looking at and which bucket it fits in. What does that mean then in terms of growth, in terms of scaling your company, right? Do you think about what's the target that you would raise in a fund, and then subsequently who do you need to hire? How do you think about scaling up sort of the company in that way?
Excellent questions. Probably our target raise, and this is just because we've not put a lot of thought into doing a fund. We probably seek to raise 20 million, which should allow us to do 80 to 100 million dollars in deals. And there's probably at least 3 hires that we would have to do in that: an investor relations person, which right now is me, and some of the other people on our board, an analyst, and then a deal flow guy. Right now we've got really good deal flow. And I don't know how many transactions are getting done. Last year deal flow was awful.
Mm.
But it's like right after the first of the year, deal flow, quality deals just started coming out of the woodwork. And it's because I don't know that a lot of things got done last year.
Mm.
I think there was a lot of sellers who were not acknowledging the impact that interest rates have on asset prices.
Yep.
And so sometime over the holidays or after Thanksgiving, they just say, all right, I'm a seller or I'm not a seller. And there's still stuff that's on the market that we wrote offers on last year, and that's still out there, and they're going to stay out there because they've done a lousy job of managing their leases, and they look at their asset like it's a piece of residential property. They're looking at price per square foot. So that's not the commercial world. It's what's the NOI. So, anyway, I'm chasing a rabbit tail now, but
no, that's an interesting conversation too, because I'm a proxy for that. So the people that hit my desk are retiring real estate investors. They're sellers, and I can confirm that's exactly what's happened. We're seeing more this year, but yeah, there's a standoff a little bit. But what marches on is time.
Yes, and right now in the current environment, time is not in the seller's favor.
No, it's not. So at some point, you're gonna need to come to reality of exactly as you described. Are you a seller or not? You want to sell or not? Is it going to be the same price as 2021? No,
nowhere close.
Sorry, it's just not.
It's going to be 25% less.
Yeah. So can you rationalize that? Can we make that work? And that's kind of where we kick in with like, okay, what income can we earn?
Right.
Meet your needs, yes, no, right? Like I feel like that's the part for the majority of our clients that's been sort of missing, that they're not thinking about. They're only thinking about that asset, the market. What price can I get before? What can I get now? It's less. I'm sad. I'm gonna do nothing. Right? You haven't thought about actually the price you get now. We can make that work.
Yeah,
we can make that work. Here's how. Right? I think folks aren't thinking about that. Maybe they are now. I'm very surprised to hear that you're seeing quality deal flow this year.
I am.
Interesting.
Quality deals, at reasonable prices, and I think it has more to do with the market that we're in. Because there's not going to be a big debt wall problem throughout most of the South. Certainly not in Nashville and not in Huntsville. These are very balanced markets, and I'm glad that they've come back to balance, because they were such sellers markets. Yeah, I wasn't buying assets at 3 caps. I mean, there was no way to ever make that work, and a lot of those deals are getting unwound. There are going to be individual problem assets, as there always are in any market. But as far as any kind of a massive foreclosure thing, it's going to be highly regionalized.
Yeah, I just don't see it either. We've been kind of preaching this song for a while now of there isn't distress if there's a single asset or multiple single assets in, say, a given market where there's a deli line around the corner of people to step in and take over that property. That's not distress.
That's correct. Yeah.
It's going to be bad for the investor and the owner of that property. Yes, it is. And
it's their distress. It's not market distress.
It's not market distress, because the banks in this case are solid.
Yeah.
Even reserve the losses for the office, quote unquote. They've reserved the losses for those too. So, I mean, we're going to change owners of some of these buildings, and some investors are going to lose capital, and that's bad.
Yeah.
But a massive event, I don't know. I don't see it.
Yeah. Well, and you know what reserving for losses at banks is? That's those are excess profits 2 years from now. I mean, I'm a CPA. I know how the game is played. We're going to reserve right now when nobody's expecting us to make profits, so we're going to reserve. And then when we want some profits, we just release the reserve.
We unreserve. Exactly. Yeah, it's a little bit of a shell game there, but it's not a bad thing. I mean, stable banks are going to help. That's a good thing. So it's kind of a good thing. This is fascinating. So then, as you watch deal flow get better, do you get pickier? So as you watch more and more deals come to your desk, now you start to be a little bit choosier. Is that how do you sort of think about your underwriting from that perspective? Does it change a little bit?
I say no, I'm not getting pickier, because our underwriting parameters haven't changed. And so our formula is we are cash flow investors So we're not necessarily doing fix and flips or value adds and I've done development in the past. I love development, but I'm just, that's just not who we are today. That takes a completely different skill set than I have.
Mm-hmm.
So anyway, we're just doing deals that can generate cash flow for the investors from day one, and which makes them kind of simple and kind of boring. And at the end of the day, for the nerd, we're really just trying to get a spread between the cap rate and the interest rate.
Mm-hmm.
If my interest rate is 8.5, and we're getting banks coming down here who are already at 7.75 again, because they've all got tons of cash that they want to lend, and so you borrow at 8, can you buy at 9? At a 9 cap or 8.75. And then you create that spread, which throws off cash flow to the investors. So the best deal that you can get. And so in essence, that's the same thing I was doing in 21, and same thing we did in 22, same thing we tried to do last year. And we did 2 deals last year. And one of them we literally worked on for 12 months. That's a whole nother story, but and so we're still doing the same thing. Interest rates is just a variable in our formula. And so the old adage, you make your money on the buy. And so we're just trying to get the price right based upon the other economic factors that are on the ground. And like I said before, the good part about this, if I can make a deal work today at 8.5, we're going to be cooking with gas 2 years from now. When we refi that, pull money out, give it back to the investors tax free, and we're at 6%, or whatever. So
how do you think about that? I think that's it's just math, right? When I think about that dynamic of the cash out refi, are you planning for, it would be nice, I would imagine, to have the next investments there waiting for investors?
Yes.
Is this sort of, right? Is that sort of
that's always the thing. Yes, I've just given them money to do my next deal with me.
Buy money. No. Like, stay here.
Yeah. Yeah. And most will, some won't.
Yeah.
Everybody's at a different stage in life, and God bless them, and we love them for that. But most will, and some of them, we've had some investors who have passed away, and so we're dealing with estates and stuff. So I don't expect the estate to reinvest, but maybe some of the kids. You never know.
Yeah. So. Very true. I think same from our desk. I think a lot of our investors are expecting us to be ready and able when that investment produces cash or turns over, that we've got the next thing ready to get moving for these folks. So same way here. This has been great. What am I not asking? Anything you want to add, Stuart, that I didn't ask about?
No, I just I just think real estate's such a great asset class. And your audience may already be completely sold on this already, but I just, it gets my dander up, if you would, the way Wall Street has taken real estate and put it over as an alternative asset over there with crypto and art. And it's like, no, we're not alternative. We're the original asset class, and we're the safest asset class, and we're the most stable asset class. And the only thing that the public markets have on real estate is liquidity. And I actually think that's about to change. It's not coming quickly, nor should it. But with the tokenization of Reg D deals and Regulation A, if you're following what Arrived.com is doing with single family homes, I mean, it's going to be a game changer. And once you bring liquidity to investing in real estate, it's a whole new world.
Yeah. As a former Wall Street person myself, and our listeners have heard this more than once, it was the reason that I looked at real estate sideways too, was liquidity. Like, not liquid. Next thing, right? That makes me nervous. Sometimes that can be a good thing because we are trying to make returns slowly over time.
Yeah.
And liquidity is not necessarily a great thing to do that. However, we've seen this too and this is something we're working on illiquid alternatives. Don't like that terminology either. Providing liquidity there just makes everyone feel better. Yeah. And that's really, we see it as more of a psychological thing for folks. Like, they want liquidity. I'm like, oh, cool. You want liquidity. Great. Why? And they really can't articulate why. It just makes you feel good. That's why.
Yeah. Flexibility.
You don't really actually need it, but it would feel good if you could have it. Right. Yeah. So if you can just provide that we say it's a break glass in case of emergency option. As long as that's there, I think people just feel better about it. Right. You're right. That would be a big game changer.
Yeah. Yeah. To the people that need the liquidity, I ask them, are you really an investor?
Yeah. Yes.
Because, I think the entire financial media and most of Wall Street is geared towards trading, not investing. Mm-hmm. Investing is a long-term game.
Yeah.
Liquidity is nice. It is very comforting to know that I can take that Apple stock that I hold and I can turn it into cash in 3 days. So, and it's a very nice quality, but people who are keying on liquidity, first and foremost, I challenge whether or not they're really investors.
Mm-hmm. And if you need liquidity, take it right now.
Yes.
Let's go solve the problem with the liquidity today, and then we'll invest and make some more money. That's usually that's a good answer. Stuart, this has been great. Where can folks find you? It's the best way for them to get in contact with you.
Easiest way to find me is at harvardgrace.com. And you can find links to me and my Calendly link. And I do invite anyone and everyone who just wants to chat real estate to book some time with me. Because I'll talk with you till the cows come home. And so reach out. There's also free resources there at the site. My favorite is questions you should be asking your passive investment sponsor. Really good questions. Anyway, reach out, check us out.
No, it's awesome. Stuart, thank you so much again for joining us. I really appreciate it. And thank you everyone for listening. Until next time, see you later.
Thanks, Brandon.
Thank you.